Half an hour away from the open in Hong Kong, Shenzhen and Shanghai mainland markets reopening today. A lot to look ahead to. You're watching the China Show. I'm Yvonne Man with David Ingles.
Let's get to your top stories today. Traders are gearing up for a frantic reopening of mainland markets with optimism over stimulus running quite high is an understatement. Now, Beijing's top economic planner is set to give a briefing in the next hour. Now, broadly speaking, equities across the region are under pressure, though, following losses on Wall Street driven by the sell-off in tech. You also have Middle East tensions, of course, and bets on a smaller Fed interest rate cut.
And I'm Annabelle Drewlers, live in Taipei for Hon Hai's annual Tech Day. The company best known for building iPhones now looking to EVs, AI as the next big growth drivers.
Are you ready? All right, we're just 1 hour away from that NDRC briefing. And of course, take a look at how futures are set up here this morning. It is all about one game in town. It is the reopening story of these markets in mainland. And after 7 days, traders have had a break to really think about what this stimulus means and whether we're going to see that catch-up rally that we saw in Hong Kong. Rest of China-wise, you could take a look at how stocks are a little bit cautious leading up to this reopen. Of course, we're dealing with some things, whether it's oil prices and Brent, that's back above $80 for the first time since August, given some of the Middle East tensions. And then, of course, when you take a look at this bond sell-off that happened overnight, we're seeing that play through in the Asia bonds segment here because it seems like the possibility of 50 basis point cut from the Fed is now turning into maybe no scenario here, right? That we might not actually see that for November. So that continues for another day. Treasuries are, though, pretty stable, although you watch that U.S. 10-year yield. We have basically broken above that 4% threshold. The 2-year yield did briefly break that, but we are still talking about 395 levels for the short end of the curve. Dollar yen's at 147 here right now. We're taking a look at Taiwan markets just coming online, and we are slightly on the back foot here this morning. And we're watching, of course, it's all about China, right? So you take a look at what we saw, whether it was the futures, we have holiday data, at least the prelim side of things of what we've been seeing so far. It looks like from the headline numbers, things have been looking pretty strong on that front. But how big of a frenzy is it going to be, right? Morgan Stanley has flagged about overheating risks in the A-share market here once things do reopen after that 5-day holiday. So watch that very soon, that they could hit that overheat threshold, according to Morgan Stanley's Laura Wang. There you go. Futures are up about 1% here right now. We're watching those CGB yields also. Are we going to continue to see a sell-off in government bonds if this equity market continues to fly? 705 for dollar China, Dave.
Yeah, well, investors will need to fund this equity market rally in some way, right? And one way to do that is, of course, this crowded trade of going long CGBs. I mean, certainly you see that. I mean, the iteration of that here in Hong Kong have been funding costs really going up because, again, you know, there's a scramble for Hong Kong dollars getting into this equity market rally. That being said, banks, brokers, travel, consumer staples, semiconductor stocks, just a partial list of the sectors you'll be wanting to keep an eye on, of course, going into the open today. I would imagine, though, to Yvonne's point, the math sort of breaks down because, you know, the futures were up 15% while China was closed. Many of these stocks have a limit up of 10%. We were up 8% going into the close right now. So if we do get a whole flurry of mainland stocks hitting their limit up in the early minutes, where does the index go after that? So as far as that's concerned, the piping was also a big issue going into today.
Yeah, well, you talk about just what we saw the last few weeks where there was technical glitches. I mean, I think you had that great story from local media talking about how they've really been not really having much of a golden week because everyone's trying to fix up all these different types of technical issues.
Yeah, they were stress testing the exchanges.
So it really wasn't that golden of a holiday, I guess you could say, for some of these traders, brokerages out there. But certainly that's going to be the key thing to watch. Is this going to be a smooth reopen? We might see a bit of volatility, so brace yourselves, guys. But yeah, there you go. This is what we saw for the past 5 days on those A50 futures, a 15% gain. So what does that mean when it comes to when A-share markets reopen? Let's bring in our Min Lo, China correspondent, joining us here right now. How busy is it going to be today?
Yeah, well, we're expecting to see huge numbers of retail investors jumping into the fray, just judging from how much interest there is to open up new trading accounts over the Golden Week holidays, right? CCTV, the China State TV, last night reporting that these brokerages are recalling their staff back from the holiday to cater to client inquiries 24 hours a day. And some banks also extending operating hours forward to extend the window for certain transactions to be carried out. And as you said, the stock exchanges also doing these stress tests to prevent the sort of glitches that we saw about 2 Fridays ago. And if Hong Kong equities are anything to go by, we were up, 11% when China markets were closed. So we could be set up for this monster rally. And also you have the NDRC meeting. Depending on whether officials meet or beat expectations, traders could be in for a roller coaster ride today.
Yeah, well, the expectations are running high ahead of this, the briefing in the next hour. So the NDRC, put that into context for us. What can they say? What should they say?
Yeah.
And, what are expectations that might be a little bit outside their mandate?
Yes, so many economists are expecting that China could introduce a stimulus package to the tune of 2 to 3 trillion yuan. But normally any increase in the fiscal budget deficit has to be decided by the State Council. It has to be approved by the legislature. And if China issues new special sovereign bonds, that's usually decided or announced by the Ministry of Finance. So State Council, Ministry of Finance officials, they are not present at today's briefing. So what we're expecting is actually what the title of that briefing, it says implementation of incremental economic policy. So we're not likely to get the size of that new fiscal stimulus, I think, today. It's more of perhaps hints of what sort of measures there would be to boost consumption and investment, maybe which sectors of the economy could get more support from the government. And maybe we will also want to look out for whether NDRC will announce the widening of the usage of local government bonds, because although Ministry of Finance issues those bonds, NDRC gets to approve which projects gets funding from those bonds.
Yeah, I think Bloomberg Economics had a good take on it, right? It's more about how they're going to implement all this versus actually announcing new stimulus.
Something new, yeah.
So you might be disappointed in some ways. We're not too disappointed, though, with some of the data that we got over the Golden Week holiday. What does it tell us?
Yeah, we're still waiting for official data from the Ministry of Culture and Tourism, but Meituan had some data saying that they saw a 40% increase in in-store dining and also 70% increase in daily tourism spending. So that's a pretty big number. But of course, the number we want to pay attention to is not total spending, but the per capita spending. That will give us a better sense of consumer confidence. But also there was a lot of home shopping during the holiday. State media, again, CCTV, reporting that during the Golden Week holiday, they saw a 50% increase in prospective home buyers' visits. And in Shenzhen especially, we're seeing a 10-fold jump in home sales in the first 6 days of Golden Week holiday. So a very immediate impact from those measures that were outlined by the PBOC in terms of lowering mortgage rates and down payment ratios.
Min, thank you so much. Min Lo there, our China correspondent. Amid all the excitement, certainly it's important maybe to take a step back at this point and take stock. As far as valuations go, so we're up 40% on price, and it took us 3 to 4 weeks only to get us back to average. So we were trading below your 10-year median on pretty much all the benchmarks 3 weeks ago. For some, we're above that already. And in some cases, like MSCI China, 11.5 times is where the 10-year mean is. That's exactly where we are right now. So what do we need for further multiple expansion? Do we need the economy to improve? Do we need earnings to come through as well? Do we need global investors to step back in big into this Chinese market? Let's bring in Joe Little, Global Chief Strategist at HSBC Asset Management, here with us and on set. It's nice to see you.
Hi, David. Nice to see you too. Hi, Yvonne.
Well, you're back. Is China back?
Well, I think a lot of investors are beginning to be encouraged around the conclusion that we've arrived at China's whatever it takes moment. Now, look, the first set of initiatives that we've seen around liquidity support is a big boost to sentiment, confidence, and shifts the outlook for the stock market. It puts a policy put in place. And like you say, the instant consequence of that is a big move on in the rating. So, I mean, China was trading below 10 times. Now ratings moved on considerably, big market shift in that valuation. We're still trading at a significant discount to other emerging markets and a significant discount to developed markets, a really significant discount to developed markets. So there may be a little bit more to run around that re-rating process, the liquidity measures, and then some more news on what the size and composition of the fiscal stimulus looks like. They're the sort of the important stepping stones for that. And then I would say, if you like, the third element to this process, which comes further down the line, is something more around structural reform, productivity enhancing measures to try and create this sense of high quality growth. But look, so far so good. We're moving through these different steps. And I think what investors are looking for now is a little bit more detail around the size and particularly the composition of the fiscal measures as the second step in this big, comprehensive set of policy measures, which we expect to play out over the next maybe even 6 to 9 months, looking ahead to the NPC next year.
Right.
There's a number of key points where we're going to see, I think, policy measures being let out into the market to begin to move the story on. But for the time being, we remain positive on China stocks, and we think this is an important process. And the global investors are warming up to the story again.
Yeah, I was going to ask you, what are calls like with these global investors? Are they receptive to what you're just saying just now, or are they still not convinced quite yet?
Well, I think we've seen false dawns in the past.
Yes.
And I know you were talking about them on the show yesterday even. So the missing point is around what happens on the fiscal piece.
Yeah.
The size, that sort of whatever it takes dimension to the measures eventually. Maybe not today, but eventually. But also the composition. So these measures need to be directed at boosting up domestic demand. I mean, Keynes had it right in 1936, right? So the playbook here is not so novel. But, of course, the implementation needs to reflect the modern structure of today's China economy, focusing around social security measures, supporting consumers to be a little bit less precautionary with their savings, focusing around this challenge with local governments, and injecting capital into the banks. They're the first sort of set of 3 measures that I think global investors want to see. And that begins to then move the story along. The rating gap can close, the China discount can close, and then some of the more global dynamics that are going to be boosting, we think, the outlook for emerging markets on a 6 to 18 month time horizon kick in as well. So Fed cuts, weaker dollar, the soft landing story. That can all help the emerging market complex generally. But in the first instance, this is a China idiosyncratic story, and we're waiting for the details to really build up confidence that it's real this time.
It's a reset. It's a reset of expectations. Let's call it if and not so much when, but if the time comes that global investors are ready to reallocate back in a big way to China, what winners become the losers? How do they fund this exposure to China? How do you suspect that plays out?
Well, it's interesting. Since we've seen those initial announcements of the liquidity measures, some of the stars of the third quarter haven't really performed that much. So I'm thinking more about the South Asian markets, ASEAN, maybe India to a degree. So that's probably the first place to look and reflect on. Within emerging markets, there's been the obvious laggard has been Latin America, and that remains so. So there are funding sources within emerging market risk assets, if you like, for investors. And I think that's probably the most likely source of give up in performance, rather than necessarily looking to the China bond market in the first instance. The China bond market dynamics are going to be interesting. We're going to be particularly watching the level of yields, but also the shape of that yield curve to really get a sense whether bond market investors are going to be more confident around the reflation story, because this whole thing is really about, can China exit from deflation? But I think in the first instance, some of the relative performance of Southeast Asia, South Asian markets is probably something to look at from the other side of that pair trade.
Right.
Yeah. Joe, we'll have more from Joe Little there, Global Chief Strategist at HSBC Asset Management. We are checking, of course, futures are all over the place here right now. In fact, we started things off with a punchy gain. Now we've erased those gains here and actually seeing futures in the red as we were just about 16 minutes away from that open. And there you go. Here's your CGB sell-off that continues here. And you are seeing most of the movement here, either the belly or the long end of the curve, where CGB's 10-year is at 223. So 2 basis points higher here this morning as well, Dave.
Yeah, so we're coming back after a week-long holiday, so we'll get an assessment on markets from UBS joining us later. UBS Global Wealth Management. And speaking of the long holiday, Accor's Greater China CEO Gary Rosen also joins us to tell us what they saw in terms of travel and spending these last few days or so. Counting down to the open in Hong Kong, the reopen in mainland China, 15 minutes away. You're watching The China Show. Good morning. Right. Welcome back. One by one, the various doors of this mainland market are starting to reopen. You had futures coming online, bonds, commodities, and now you have the reference rate of the day, the first one in over a week, 70709 against the U.S. dollar. The estimate was 708. 11, are we seeing some reaction? Dollar China. Of course, the key thing here is the onshore rate reopens as well in 12 minutes. We'll see what sort of adjustments we see there.
Yeah, that takes a bit of time, right? As we've been seeing with some of these commodity futures here this morning. But yeah, look at futures right now that continue to see deeper declines. We're talking about 1% across the board now. So not sure what that tells us of what this Tuesday morning is going to bring. But we're back with Joe Little, Global Chief Strategist at HSBC Asset Management. Before we actually talk about this reopen, which we've talked in great length, rounding out right now, there's a big narrative out there that perhaps we might not even see a soft landing and in a no landing scenario. Markets are repricing here right now. I mean, how high of a bar now is there for a no rate cut situation from the Fed?
Well, I mean, it's a bit of a dance, isn't it, Yvonne? One of the challenges, I think, in looking at near-term or short-term market moves is the market is so hypersensitive to the latest data points, to the latest data news. It's exhausting, actually, when as you're tracking the news flow around the labour market. But it's particularly the growth signals and the labour market data, which seems to be really impacting expectations around interest rates for the Fed, but also the broad sort of tone and mood in global markets as well. So, yeah, you're quite right. Many market participants are talking again about this no landing idea, that growth can reaccelerate, that inflation risks haven't gone away. I don't know, on the balance of data that I've seen, it makes me more comfortable with the soft, or as I've called it, the soft-ish landing. It makes me more comfortable with that. It makes me less worried about the harder landing recession risk, which, of course, was a big theme over the summer months. Many investors getting more nervous about a recession risk materializing. So I think the data that we've seen, stronger labour market data, progress being made on inflation, makes me more comfortable with the soft landing. I'm yet to be confident or convinced that there's evidence that inflation is coming back in a big way. We see a feature of that in markets like Brazil, where the central bank's raising rates again, but it's more connected to fiscal deficits and worries around longer-run inflation control rather than something new going on in goods inflation today or services inflation today. Clearly, we have to watch oil markets and freight rates. That's important. But at the moment, our scenario remains, base case scenario, remains that we're heading for the soft landing. And I think the data kind of confirms that conviction. So that's the story for the economy. And in markets, it points to a broadening out, an opportunity for emerging markets to continue to perform. And all of that is, of course, amped up with the developments that we were just talking about in the China policy situation. So everything seems to point to a really interesting window for emerging market asset classes to perform.
We're also going into U.S. earnings season. And, again, to your point, this dance between how bad or how good are things. Where do you think expectations are going into this earnings season in the U.S.? Well,
expectations around profits are still strong, and quite rightly so, because that's been the signal, actually, for calming your pessimism down. We've seen some weaker signals in the labour market trends. We've seen some weaker signals around consumer confidence. And we've seen, obviously, the challenge with some of these key market indicators, such as the SARM rule or the yield curve, that there have been flashpoints and leading indicators to make investors more concerned about recession risk over the last few months. Some of those are ebbing away now. Some of those are maybe sort of still percolating away in the back of people's minds. But the existence of strong profits growth, S&P 500, equal weighted S&P 493, the sort of the rump of the S&P outside of the Magnificent Seven, the existence of strong profits growth there, and the better news that we've seen on some of the smaller cap names as well in terms of profits growth and profits expectations, that keeps the whole sort of soft landing show on the road. So yeah, we're looking for another a good phase of data from corporate profits, and I think that's an important element for investors to see, to again confirm this idea that the soft landing is coming into view.
Obviously, we're coming into less than a month away from an election. You have geopolitical risks as well. How should I position around those two big themes coming up too?
Yeah, so November is a really interesting passage of time. It's like that Mark Twain quote. The most interesting months in markets are October and November and September, and there's an awful lot going on. So maybe every month is quite interesting. But that's not quite the quote, actually. But you know what I mean. Yeah. So, look, November's an important passage of time. We've got the US election and we've got a two-day Fed meeting then thereafter. I think what that does is ahead of that, and then maybe during that phase, inject a bit of volatility into markets. So what we've said to investors is, preparing for a more volatile journey in markets, connected to the fact that there's this hypersensitivity to market data in rates markets that could spill over into credits and stocks, but also because we've got these big events around the Fed moments and around the US election. That all adds to a situation where we could see more volatility in credits and stocks in the fourth quarter versus a surprisingly low level of volatility in those asset classes year to date.
Joe, pleasure to see you. Yeah. And I suspect we'll see you, if not before the end of the year, in the new year. Thank you so much for coming in. Joe Little there, Global Chief Strategist at HSBC Asset Management. Going into the open today, we're down 1% on the Hang Seng Index in the early goings. Futures are also losing a bit of steam, not to say anything really at this point to extrapolate what the mainland reopen looks like in 6 minutes from now. From now, this is the China Show. All right, we've been waiting for this moment for about a week now, 4 minutes to the opening bell. In terms of valuations and how far this rally has come, we're back to square one. We're back to the average. MSCI China is back to 11.5 times earnings. Hang Seng is trading lower 1% in your pre-market. Now we're looking ahead to the reopen, of course, on the mainland. And my, oh my, are we set for a massive rally at the open. The CSI 300 is poised for a 10% reopen in the opening minutes. More on this in a moment. After a week-long break, brokers have been scrambling to get ready for this moment, Yvonne.
Yep, that's Shanghai. Let's take a look at Shenzhen, though. Chinex rising some 18% too. We'll have plenty more to come. The open and the big reopen is next. This is Bloomberg. All right, time to get your blood pumping here as we talk about this reopen. It's been 5 days where markets have been shut during that Golden Week holiday, and you're already seeing that CSI 300 is set to open higher here. Hang Seng, though, might be doing a different story. So a lot of focus is really going to be on domestic benchmarks here today. We talked about the Chinex is flying some 18% in the pre-market as well. And we're watching very closely how those CGB yields react. So far, we are still seeing that bond sell-off extend once these markets reopen, Dave. But certainly, we talked about it being a frenzy. It's going to get busy. Extremely busy. 10%, 11% on the CSI 300 in the opening minutes. That's important to note. We were just showing our viewers futures there, which I would ignore for now. And the reason I simply set that aside is because the catch-up element and the adjustment higher, the pent-up demand was waiting on the wings going into, as you can see, the substantial open today on price. So 11% should be the best day in over 15 years. 8% already was going into this break.
Shanghai comp 10% higher. Shenzhen is better by about 12.5%. A look at every single sector and really just a double-digit gains you're seeing there. So if you want to maybe take an average, you take it over 5 or 6 days. That's what you get. You know, it's time over. Well, it's a move over time. Every single sector is higher. CSI 2000 is up 12%. Really, to get a sense of how we'll revisit the sector groups in just a moment here. We'll look at volumes, turnover. Glance at the bond markets very, very quickly because there's also the oil story. This move up in commodity prices like iron ore, for example, if that is trading, by the way, and they are. So 10% higher on Shanghai crude. In case you missed it, the big news overnight was Brent trading back above $80. That's an element of catch-up there. Iron ore is trading higher as well. This melt up in yields, right? The narrative here is how are investors funding this equity market rally? It was crowded going into CGBs. That might be one area to watch. This further melt up in yields. And really, at some point, right, if you do believe that a lot of these measures might lead to China and reflation in China, it does make sense to see yields moving up. That might be too early to have the conversation, but it's something to watch, of course, moving forward. CSI 300, MOV, a glance at market breadth, and some of the big winners that you should be seeing on your screens. 20% higher for many of these names. SMIC, of course, is a big one because of the big moves we saw in Hong Kong going into right now. What's interesting, though, is from the open, we're looking at us coming off highs a little bit. We're still at 400 points, though. As you can see, every single stock, with the exception of 2, are moving higher. So this is a broad-based rally. It's an adjustment higher. A quick glance at Hong Kong, please, if we can. Hang Seng China, where really, when you talk about valuations, we're now actually back in and around your 10-year average. So we are seeing declines across the major benchmarks and across the major stocks, most of them, Yvonne, in the opening minutes in Hong Kong, although the story is completely different when you look at things onshore. Yeah,
it is really all about what we're seeing in domestic markets. And you mentioned that 10% move on the CSI 300. I'm looking at my SINs here on the terminal. I think that's never happened. In fact, it's the record move that we've seen on the CSI 300 and how much it's moving this morning. So certainly that's one to watch. Let's bring in Eva Lee, head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. I don't even know where to start. How long can the sentiment boost last, really, Eva?
Well, today is a very important day, right? We all know that at 10 a.m., NDRC it's going to have a press conference. We are expecting the committee is going to announce more fiscal measure. How much timing, scale, it's all important. And that will determine whether this rally, how much leg up that we can have from the current level.
Okay. So what's the advice? What are you telling your clients? I mean,
yes.
What information do we have now that could give good advice to clients? You know, we're up 30, 40%. We don't know what's ahead. We could be up 40% in another 4 weeks. We could be down another 40%. So how are you looking at things right now?
When I see an investor, of course, I do not know how much they have of China stock as a percentage of total portfolio.
Okay, that's a good starting point. Yeah.
So I categorize them into 3 buckets of investor. First bucket, they already have a lot, which is usual. Okay, for my clients, home buyers, they hold a big proportion of these Chinese stocks. And for those, we will advise them, use this very nice market to rotate and also to diversify out of China into something else. That still give you growth, valuation still attractive. For those that are well below the benchmark, we say 6% of total portfolio should be in China, only 6. Then if it is well below that, maybe use the current market to add internet, to add consumer stocks, maybe select autos, and financial as a bit of a yield perspective, energy as a yield perspective. So that's the under. For those, they're not too convinced about this rally, not too convinced that China is able to, sort of tackle all the issues with the current monetary measure, then they probably want to short. But I said, no, this is not a good time to short because policy-wise, it's so uncertain. So that's how I usually start my conversations with the investor.
I'm just thinking about this NDRC meeting and the fact that we're not going to get anybody from the Ministry of Finance. The fact that it's happening at 10 a.m. versus that PBOC meeting that was happening right before markets started. I mean, what does that tell you? Is it going to be more about just how they're going to implement what they've already announced? Or are you expecting actually new stimulus measures?
Well, I think what we have known is the monetary measure. And we always defined when we say, okay, the market needs some form of economic reform, changes. Monetary only one out of the three factors. We need fiscal, and then hopefully some real economic major reform changes how they treat private versus public enterprise. The private versus SOE, right? So these are all the changes that we need to see an actual re-rating of the market. Monetary, not enough. We need fiscal. So if at the NDRC they give us this fiscal, this is what the market is looking for, that will move the market. But if it is just they give more details about the monetary, which they only give the framework, they did not give any further details before holiday.
Yeah.
If they give us more details, how solid is the details?
Yeah.
How much of an impact that will have on the economy and corporates, that will be important too, in terms of determining whether the current rally it has priced in all the positives or not.
Yeah. But it's the NDRC, and also it's the NDRC. You don't have the Ministry of Finance present. As Min, our China correspondent, pointed out, any increase in the fiscal burden needs to be approved by the State Council, for example, right? So the fact that it's only the NDRC, what is a realistic expectation to have?
Well, I agree with you that maybe not so much. Maybe they delayed that hopefully fiscal measure announcement till 18 when they announced the not very good September data.
Activity numbers, yeah.
Activity numbers. Or they wait till the end of this month, which they have the standing committee meetings to announce more details. But anyhow, October will still be a very important month if people already invested or plan to invest into China.
You mentioned about chasing some of the beta. You're still thinking stay exposed to some of these high-yielding dividend stocks as well, whether it's the telcos, the SOEs.
Yeah.
Why is this one, I guess, volatility-proof in some way, this trade still?
The two factors. First, we have U.S. election, 5 or 6 weeks away. No one knows. They're very close, right? Everyone knows the two candidates very close. If Trump, step into the office, we know that the tariff will come. This is a major tariff that will affect China. So that's why I need a yield protection. Second reasons, if you look at the details of they give 500 billion for banks, insurance companies to invest. If you were given the 500 billion, where would you invest into? Would you invest into the high-risk tech stocks or into something that I know I'm going to get my money back, which is like banks, energy, because they got yield. These are big caps. So that's why I think two angles making us believing that these yield stocks still have room to go. I know that it's defensive. It looks like, why you placed your money in defensive, but there are reasons behind.
Right. You mentioned re-rating. I want to ask you about valuations. So we've re-rated back to normal. Do you think we could get further multiple expansion without an earnings follow-through, without the economy? Because at some point this rally, at some point soon perhaps, this rally runs into a wall where you get bad economic data. And you mentioned the 18th of October is coming up as well. How can we look through what seemingly will still be very soft numbers the next few months or so?
I think the market already expected very bad numbers, or else they would not have come up with these, major measures. First thing. Second thing, it's now with all these measures, and then soon enough in the late October, early November, we have result season. How corporates would talk about these measures will also be important. Whether we would have a further re-rate. Because at the end of the day, right now we're talking about 11 times, 11.3 times for PER. Is it very expensive compared to the other international market? I don't think so.
That's right.
It's below average, So whether it can trade slightly above average, it all depends on corporate's earnings. If we're talking about, okay, if I have mid-teens growth, why I cannot trade at 15 times or even higher for a PER? If you look at the Packer PEGR ratio perspective.
All right, our question today is really, where does this take us, right? We've seen, 30% gains in Hong Kong. I think we're talking about 17% gains on the CSI 300. How do you think stocks will fare by month end and maybe even year end?
Ooh. It all depends on what we receive, though, right?
Yeah.
So in the near term, assuming we don't have any additional major big-scale fiscal measure, we only expect low single-digit return. By the end of this year, if we still do not have any major measure, probably we will end, at this level. But that said, internet stocks actually could have more upside. Somehow, when I look back, historical average versus now in terms of valuation, this still suggests near term probably 5 to 10% upside, medium term 15 to 20% upside. But that's very different. I mean, I guess different sector valuations, where they were, what sort of growth they project, I think that will affect, the potential return.
Right. And of course, to Eva's point, we'll find out in about 19 minutes whether we get that further catalyst. Eva Lee will be rejoining us later on the show. She's with UBS, of course, Global Wealth Management Office. More in the next hour of the show once that briefing, of course, gets underway in Beijing.
Yep, and it's still pretty crazy here out there when you take a look at how Shanghai markets are doing. And there you go. We've come off some of the top, but yeah, we're still talking about 8% gains in your CSI 300 here right now, Shanghai Composite. And it's really Shenzhen that is really on fire today. Take a look at that. We're 16% upside there in Shenzhen. Hong Kong is where you're seeing that pain. And, really, we've had a good few days, obviously. So there is a bit of profit taking coming through from Hong Kong. And so it is A over H today. And of course, we are starting to get China's Golden Week holiday spending data. That's coming up next year as well. You talk about the headline numbers of what we've seen so far. Not just, private data like Meituan talking about people are going out, they're eating, they're spending more. What does it mean for the hotel sector, right? We'll be digging that deeper into with Accor, with getting their thoughts on how Golden Week fared with the Greater China CEO, Gary Rosen there. This is Bloomberg.
All right, welcome back. Just a market update, 14 minutes into the reopen in China. So a couple of things are happening, right? So we're seeing massive profit taken in Hong Kong. Futures are futures are lower. Although, as expected, though, a surge in price onshore and volumes are about 400%, the 30-day average. And, of course, you have to sort of discount that because the last 7 days didn't have trading. But that being said, we are seeing just a piling in of buy orders at this point in time. A lot of these stocks at this point in time are still trading limit up 10 or 20%. So we'll see what happens for the course of the session.
Yep, still looking strong, of course, as we await that NDRC meeting just 15 minutes away. In the meantime, though, let's take a look at what's trending in China. Look at some stories making headlines in national media. And it is about the stock rally. And holiday data are dominating coverage across Chinese media today. A front page editorial in the China Securities Journal is calling for more measures to strengthen investor confidence in A shares. Now, the paper says regulators should accelerate policy implementation to promote a sustained economic rebound and consolidate market gains.
Yeah, and media outlets are also playing up, and speaking of Golden Week, travel numbers, saying that the tourism boom highlights the vitality of the economy. Wow, that's a big word. Now, citing the Transport Ministry, state broadcaster CCTV says more than 2 billion trips were made during the week-long holiday, up 4% from a year back. Now, you look at domestic air travel, we're up 11%, and that trips made by land were up 80%. Meanwhile, Xinhua says outbound and inbound travel bookings hit a record during the holiday, citing figures from online platform Ctrip.
Yep, joining us exclusively now to discuss Golden Week consumption is Gary Rosen, Greater China CEO at Accor. Gary, it's great to have you. I'm sure you had a busy Golden Week. Can you just give us a glimpse of really how the last week has been? How has been hotel occupancy, foot traffic, the like been?
It certainly has been a week of interest and certainly a week of excitement. So, Golden Week is always a great time for celebration. Interesting enough, when you think about comparing to last year and comparing to back to 2019, certainly this year we saw record volumes, and the data that's coming out, certainly we saw that translate into hotel occupancies. I think that's the piece really to celebrate, and to celebrate effectively. Some of the challenging side of that is spending is necessarily not the same as we saw last year, which was a peak year for hotel rates. And certainly we see, we see that this year. Compared to 2019, depending where you are in the country, rates were marginally up. But look, overall, I think it's a positive story in terms, especially just for the sheer volume of people that were traveling over the last week, which is, again, down to the fact that when it comes to travel, this is something that people are always going to invest in. And I think the sense of, especially domestically, the sense of discovery and culture is so critical at this time of year in terms of travel.
Gary, just to pick up on, David here, by the way, but to pick up on what you just said there, where do you see rates going then over the next 6 months to 1 year?
It's a bit hard to say, David. In terms of booking cycles are so close in China. Our average booking time is less than 48 hours. So I would say in terms of rates, depending where you are, if you're talking about leisure destinations, you're probably not going to see a significant amount of growth. If you're seeing in corporate and meetings, yes, you're going to start to see some growth coming back, especially compared to last year. So that's an exciting part of the business that we're watching very, very closely. I think the other thing, David, which is different and what we're watching very closely, is that the trend in terms of where people are traveling to when it comes to leisure travel is shifting. And so people are rediscovering more remote places in China. There's so many UNESCO sites. There's so much wonderful nature travel and tourism that's really where we see a big part of travel, domestic travelers going, especially with the younger generation. And by the way, that's even the case as people are traveling over the border into Hong Kong. You're seeing a lot of that being driven by culture now, and interest in discovering Hong Kong culture versus historically what you may have said into shopping.
Yeah, I was going to say, tell us a little bit more about these, these new popular destinations. Right? We saw those pictures of people, staying in toilets near Huangshan just to see the sunset, for example. I mean, does it give you at Accor maybe more reason to maybe expand a little bit more domestically in China now?
Yvonne, just on that point, listen, we're betting on China. We just passed over 700 hotels in China this year. We see the growth in China, and what we're experiencing now is short term. There's no question that the growth is going to be exponential. You're still talking that China is still on track to be the largest tourism market in the world within the next 10 years. So there's no question, and Accor is betting big on it in terms of our growth strategy and our growth opportunities. When you think about where people were traveling to over the holiday, you're seeing a lot more into places like Yunnan province, and really in terms of, again, where the opportunity is for discovery of nature. It's a big part of it. When you think about extreme sports, that's a big part of it. People are really looking to discover their heritage, their roots. Food is a great way for people to think about travel, and it does really shape a lot of how people choose destinations. That's one of the wonderful things about being in China. So I think, as we look towards kind of the next couple months, David, you asked this question, we see, people have discovered skiing in a big way in China. Our ski resorts, when you think about snowboarding's become huge. We see that certainly as we come into the winter months, going to again be a big boom this year. So it's interesting that it's kind of learning as we're going, because the wonderful thing about China in terms of travel, it is so in some ways planning last minute, but people are willing to do things very spur of the moment, very excited to try things that are new, and that's helping to shape where people and how people are traveling. And for us as hotel operators, we're learning every day, and it's a great learning base.
Yeah, Gary, to your point, I mean, it's such an underappreciated story, the changes in consumer patterns, this pivot towards experience, right? Just to pivot, and just borrow my own phrase, I want to get your thoughts on what you're seeing as far as business travel is concerned, particularly inbound travel into mainland China for the international business community. Are you seeing anything specific there?
Yeah, listen, what's great to see is we are seeing the rebound of that. They're certainly coming back. It certainly is taking time. and a lot of it is being driven in terms of on-flight capacity still into China. So I think that there's no question. We see a lot of the retailers coming back to China, and the reality is again, this is still China's still the best consumer story in the world. And so again, from that standpoint, you have your companies that have large footing here coming back. You see people that are there's no question that companies are coming back. You're seeing meetings coming in now, which is great. We're incredibly excited, David, about the Canton Fair is coming up again, and we're seeing great numbers coming in for that. So we're very excited. That's a great indicator. You can talk about the large exhibitions coming in, and you're seeing that come in as well. So overall, the trend is moving in the right direction. We certainly would like it to go faster. But the great news is that we're seeing that trend move in a decent pace that we can say it's on its return.
Gary, I think we were joking just before this Golden Week that many people were not too optimistic about traveling. They were probably going to stay at home. And then we had this kind of stimulus blitz from policymakers, and people were like, I'm going to start booking my trip to Europe. Have you seen sentiment change since we have seen this coordinated policy response from the heads of state now?
There's no question, Yvonne, it's a great point. There's no question. I mean, outbound, and you showed numbers, outbound is surging. And you can even see that. And as long as there are tickets available, people are purchasing them. I think what's interesting is to watch how people are feeling comfortable. And the thing is to always remember also, people have money. They have disposable income. They're saving. The savings right now are huge. So people are not afraid to spend, and travel is one of those areas that they are spending. So there definitely was an uptick again. And you can see that, especially when you're thinking about traveling to Southeast Asia, when you're traveling into Europe. We saw numbers into France, record numbers going into France for this holiday season. And what's also very, very interesting, Yvonne, is the Middle East and the just triple-digit increase in terms of the Middle East, because it's also a connector point into Europe now as well. And we can see that benefit coming through. And being the largest player there, we see that obviously as a major play. But I think, look, the sentiment overall, travel is something that is always on the forefront. So whether you're talking domestically, whether you're talking about people traveling outbound, there is no question that we're in a business that is something that is a business to celebrate, because people are always going to want to discover. And especially when you talk about Chinese people traveling, whether traveling domestically or globally, the sense of discovery, the sense of learning, culture is so critical. And that's always going to be the case, no matter whether you are an older generation or younger generation.
Gary, it's great to have you. Thanks for joining us. Gary Rosen there, Greater China CEO at Accor, joining us from Shanghai. We're going to see many more celebrations here when it comes to this NDRC meeting that's underway. The reporters are in the room. We're just waiting for those in the NDRC to take their seats there. But yes, we're just about 6 minutes or so less away from that big briefing here. Whether we do get some sort of fiscal boost is still going to be the key question here. Is it just going to be a work plan? Maybe not so much new stimulus. Yeah, well, that's what our economists at Bloomberg Economics think. Although the playbook from China the last 4 weeks has been outside of textbook, so those two dynamics are at play. Our guests coming up on your screens, plus the NDRC briefing. This is Bloomberg. Welcome back to the China Show. A look at the CSI 300 just a half hour into the session. And yes, it is a catch-up story we've all been anticipating, of course. And what happens in this hour could dictate where these markets are going to go in the next few minutes or so, right? So right now we are seeing A-share market flying here. Let's take a look at how CSI 300 is up some 8%, off some of the highs from the initial pop at the open. But boom, look at Shenzhen. We're still punching about 9 to 10% gains this morning, and really mirroring what we saw in Hong Kong in the last few days, Dave. But certainly what the details that come out of this meeting are going to be very, very crucial for investors in the next few minutes. Absolutely. Will they be details of implementation or something new to implement? I think is a simple way to put that, right? Do we hear something new, or do we hear details on what had been already announced, maybe some
especially moving into the next several weeks. And by the way, the Central Economic Work Conference is also coming up in December, and what that means, of course, for policy. So we're waiting for more, well, first for the officials to step back in. Keep in mind for Bloomberg clients, I believe they should be also on your terminals. There will be a simultaneous English translation, which I guess underscores also the point that Chinese officials are not just talking to the domestic audience, but also to global investors as well. There we go. The officials are in the room, and we're waiting for this to get underway. In the meantime, though, as we look at these markets, as we await a very brief pulse check of these markets, we're looking at, so apart from China, Asia's down. There's obviously the Fed conversation. You're getting a pullback, of course, in Hong Kong as well. We're down 3 to 5%, depending on the benchmark you're looking at there. There's a story of Brent and oil prices trading above 80. We on the Treasury curve, we went from uninverted to inverted to uninverted. We're back to 4% on the 10-year yield. Questions around, can the Fed still cut? They probably will cut, but of course it's a dance, as they say. This back and forth between 25 and 50, or soft no or hard landing. We can talk about all of that in a moment. In the meantime, of course, we're looking ahead to this NDRC press briefing, which I believe should be starting in the next few minutes or so.
Yeah, turnover in Shanghai and Shenzhen is at that whopping 1 trillion renminbi in just, I think, the first 20 minutes of trading. I think it took us that long or even longer to hit that milestone just a few days ago. So it looks like we're hitting records once again when it comes to turnover in this market, which is no surprise. But I think there's just so much hope that's hanging on this briefing here of what can actually be announced, right? We talk about how speculation is ripe of X trillion renminbi. Sometimes as high as 10, which is, I think, very extreme out there. Let's bring in our panel here this morning. Helen Qiao, Chief Greater China Economist at BofA, our BofA Global Research. Still with us is also Eva Li. She's back, Head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. Ladies, it's great to have you here on such a pivotal day. I know you're not putting out those forecasts out there, Helen. You said, I'm not going to join that whole line of economists. Why not?
Well, I think, first of all, there is a feasibility part of the story. How much is possibly, going to be a potential fiscal stimulus? And we have 2 months before the end of the year. And I think if we are realistic, I don't necessarily think that the fiscal package could exceed 2 trillion. Just because unless we're talking about the next 2 years or 5 years, there's no way that we go all the way to 5 or 10 trillion. And secondly, I think there is also this matter of, planning, not only like for the short term, but also more sustainably for the medium to long term. So we don't necessarily think that they are trying to deliver everything in one go and going to reach an astronomically high number right away.
Okay, just hold that thought, and Eva, of course, we'll bring you in a bit later on. Let's take our viewers straight to this live press briefing taking place in Beijing.
The whole picture and the momentum of development. That means we need to look at the present and also look at the indicators for the future. From a macro, holistic picture, we are faced with a more complex environment at home and abroad. China's economic performance is generally stable and showing progress while maintaining stability. We are seeing accelerated progress in fostering new quality product forces. We have also applied stronger measures to ensure people's well-being and made positive progress in forestalling risks in key areas. We have advanced high-quality development and maintained general social stability. And I can use 2 keywords, steady and progress, to summarize the situation. Steady or stability is mainly demonstrated in overall economic picture. On production and supply, we have stable agricultural production, and this year we are expected to have another harvest of grains. This is very important. We have rapid industrial growth. In the first 8 months, value added in large industrial enterprises grew by 5.8% year-on-year, and some areas like new energy vehicles and integrated circuits have increased their output by 31.3% and 26.6% respectively. And on the service sector, we have seen steady growth. The production index of service sector grew by 4.9%, and the information and transmission softwares and information technology services production index grew by 11.9%, and the rental and commercial services production index grew by 7.7%. Market demand, we have seen continued growth in investment and consumption. I have some important numbers to share with you. First, the investment in manufacturing that concerns the long-term development and support sustainable development and conducive to sustainable growth grew by 9.1%. That's 5.7% higher, percentage points higher than the average of investment. And we have seen notable progress in large-scale equipment retrofitting and trading progress of consumer goods. We have seen rapid rebound of automobiles and house appliances in recent months. It is expected that the retail sales of major automobile makers in September will grow by 10% compared to the previous months. In the first 8 months, in RMB terms, our export grew by 6.9%. And that is mainly attributable to our manufacturing sector. Employment and prices. Our employment is generally stable. In the first 8 months, in ABS, we created 9.44 million new jobs. That's 200,000 jobs more year on year. CPI grew by 0.2%, and in August, it was 0.6% growth. The second key word is progress, and it is mainly demonstrated by our optimization of structure. We have fostered a stronger new growth engines. I have 2 numbers. In the first 8 months, our head tech manufacturing and equipment manufacturing grew by 8.9% and 7.6% respectively. And according to our knowledge, we have better structure of the 3 major demands. In some key areas, we have seen continued improvement and breakthroughs. The new urbanization and coordinated regional development is being solidly implemented, and major economic provinces are shouldering greater responsibilities.
Zheng Shanjie there, this is China's NDRC chairman, just talking a little bit more a few minutes into this briefing. And you're hearing some lines, right? Like economy progressing with stability. They expect a good grain harvest this year. The service industry growth has been fast. So far, pretty positive tone when it comes to his outlook, or at least how his take of the economy is so far. We haven't heard anything in terms of new stimulus measures just yet, though, Dave, which is something that is quite telling, right? 8 minutes in to this briefing.
Yeah, it seems, we're 8 minutes in, right? So it's still so far descriptive rather than prescriptive. Let's get a sense of the room right now, given what's been said so far. Joining us here on set is Helen Qiao, Chief Greater China Economist at BofA, and Eva Li, Head of Greater China Equities at UBS. Helen, I'll start with you there. So far, any thoughts and your expectations as well, in case of yours missed the stage you just set a few minutes ago?
Well, I would say that I'm not particularly disappointed yet, because they usually start by describing how the economy is, and usually there's no bad news, really negative implications. They usually start with something like describing the efforts that they have made and the progress that they have seen. So I think this is a very typical starting point, but I think that now we really need to watch very closely for the concrete measures that the market would be hoping for. Because unless that they talk about what type of stimulus, especially on consumption or investment, I don't necessarily think that the people would be just as happy listening to the description of how things have been.
We talked about this 2 weeks ago during that PBOC briefing, was the fact that they came out so public, live, the policy communication, is that perhaps more important
than the measure itself? Exactly. Absolutely. We have been saying that for any of those measures they announced, for example, the triple R cut, the reverse repo rate cut, or the repricing of the mortgage, any one of them is all very imaginable. So people have always been kind of more or less expecting it will come out, but not just together. But the fact that they lump it together and deliver it in such a fashion, I think achieved the three things. Number one, it basically shows that policymakers at the very top are aware of the deceleration and they care about it. And number two, they actually did not shoot one bullet at a time. It shows that they know that by putting them together, it will have a bigger impact. And number three, if PBOC, NDRA, and also the CSRC can work together, then maybe there will be more coordinated policy easing going forward. So those, I think, in terms of policy communication, as Yvonne just mentioned, are probably even more important than what has been delivered, because it rekindles the hope that we could see more effective easing going forward.
Eva, I'll bring you in. Is there a level of better consistency and clarity that you feel this coordinated messaging from Beijing has achieved so far?
Well, I think the market is moved by that announcement, which a few committees come together, make that announcement. But I remember the market really moved. It's on Thursday when Xi Jinping come out and say we don't want to see property price to fall. I think this is the first time. And in fact, no one would have expected that he would make such a public speaking talking about it. Remember, he was the one understanding, feeling the need to see the property housing bubble or some of the high debt developers need to have, some structural changes. So he came around doing, I'm not saying he's reversing everything he has done, but definitely that's a major sign that shows you the leaders understand growth is crucial. You buy China's equities, you buy because it's got growth prospect.
Yeah.
We are not developed markets, as how I see it. So I think that's why the market or international investor start to come back to look at Chinese equities.
UBS does expect maybe there is a higher chance of maybe some sort of large-scale fiscal package. I think 5 to 10 trillion you guys are forecasting for the coming years. How much of that aid do you think the government is going to cough up to help the housing sector?
Well, again, whether this 5 to 10, it's spreading over a long time or within 1 to 2 years or 2 to 3 years, that will have a very different impact onto market. But at the moment, and also we all know that where the money is going to tackle. I mean, the local government, that issue, the housing, destocking, maybe some to corporates, and most importantly, consumption. So these are the 4 areas we need. But how they're going to, when they're going to, that's crucial.
Yeah, just an update here of some of the latest headlines coming through here out of this press briefing. There is an acknowledgement that expectations around the market have improved a lot recently. That's number one. Number two is that I'm not sure this is entirely a good thing, but context is important here, that they're confident they can fully achieve 2024 economic goals. This new policy package will be focused on issues at hand and longer term to improve the health of economic actors. Helen, I'll bring you in on this note here. You talk about the need for incentives to be more aligned with each other right now. So it's, on one hand, it's a money issue, how much money is needed. On the other hand, there needs to be some structure to the restructuring to the piping of this economy.
That's right. I'm afraid that this is not just about cutting interest rate by 100 basis points and then putting in a fiscal stimulus package of 1 trillion RMB or even $1 trillion, let's say, that can solve the problem that we currently see in the Chinese economy. In our view, there is a general lack of the positive incentives at the micro levels for both public sector and private sector participants. At the moment, we have seen that people are seeing more negative outcomes, and their expectations are actually, tilting more towards the downside. People don't see upside, and when that happens, it is very difficult to motivate them to work. whether they are a government official or actually working at the private business, or they were just a individual working at any firm and thinking about their future job security or their income trajectory. They're all worried about the downside. When you don't see the upside, then you have no incentive to innovate, to increase productivity, to spend more, to invest more, or to take risk, right? So that's the problem that we see. We think the most important structural adjustment that needs to be done, other than this just monetary and fiscal adjustment on the margin, is actually to reinstall the particular positive incentives at the micro level. People need the hope, right? They need not only the stick, but also the carrot to work better. So that's what we think would have been more helpful. But we would like to see if there is any more suggestions that such measures may be on the way.
I mean, a question to both of you. The wealth effect is important. It's hard to quantify, but I mean, the last 3 weeks has seen that fairly visibly. The stock market's done well, and suddenly everyone feels well. They go out spending. And I wonder, from an economic perspective, does a stable stock market need to be part of policy? And do you think, Eva, that they have achieved, that is the objective, that they have managed to put finally a floor underneath this equity market? Helen, I'll start with you.
Well, I think the wealth effect definitely is very welcoming to China at the moment because of the relatively weak consumer confidence level. We are approaching basically a post-reopening low at the moment in terms of national consumer confidence surveyed by the National Bureau of Statistics. So having actually some thought that people would think, oh, actually, I just earned so much money from the market. That's free money. Let's spend it. It's going to be helpful. However, empirically, it has never been proven that actually wealth effect in China has been very effective in driving consumption, be it from the A-share market or from the property market. Recall that when property prices were going up 10%, 15% every year, did that really drive so much of the consumption? Not that much, because we found that the most important driver is still the income and income expectation for Chinese consumers to spend. So in other words, this capital market rally is very helpful in the short term, but for the boost on consumption to be sustainable, it has to be sustainable by itself, and we need to see this rally basically in the medium to long term.
Okay, and now that Helen has poured cold water on my theory, Eva, I'll bring you in. And what are you seeing as far as sentiment and how sentiment has changed short term?
Well, I think how I look at it from a Hong Kong perspective, when we do a correlation between home prices and consumption, there is a very strong direct correlation with it. Okay, so that's one thing. Whether, now we're talking about stock market, doing well, for sure it will benefit Hong Kong because Hong Kong is a small place. When we talk about China, maybe the tier 1 cities or leading tier 2 cities will feel that benefit of, the stock market doing well, they were willing to spend. But if you're talking about the rural area, which I don't think they will really feel the impact, which is still, again, on the expectation of the economy. But one thing I really want to bring out is stock markets doing well. It's a very important thing for central government. Reason is, if you look back now, we all know that no people is going to put a lot of their wealth into net new money into housing market. Yeah. Where are they going to put their money? Bonds? This is not in their blood, right? They like something, good returns, stock market. But the market has been doing this, or very volatile. Put a chart 10 years, you do not get anything from CSI 300. But if that's the case, then where will these people put their pension money in? If they do not have a lucrative and strong equity market, that will be a problem further down the road in terms of paying the pension liabilities. Because we do rely on the lucrative equity market. Eventually, the SOE can do the private to float some of the assets, raise more money, and becoming like an engine to pay off these pension liabilities. So I think this is something we need to understand on a medium to longer term. A healthy equity market is crucial for central government.
Okay, we've covered a lot of ground already. Still more to go. We'll take a short break. We'll be rejoined, of course, by Helen, Qiao, and Eva Li here on our set and continue coverage of this breaking news story out of the NDRC, this live press briefing out of Beijing. You're watching The China Show.
All right, we're taking you back to those live pictures out of Beijing here at the NDRC briefing. So far, we're hearing from the chairman, and they're starting to take questions from reporters. So maybe that things will start getting a little bit more interesting. But so far, just to recap the last 20 minutes or so, it really has been more about maybe just describing how the current economic outlook is looking like here. They're going to focus more on promoting consumption, he says. They talked about new policy package focuses on issues at hand and long term and to improve the health of economic actions, but we're not getting any sort of meat in the bones yet on what that new stimulus measure might look like here. And they will speed up the implementation of additional measures. But they did talk about China looks likely to hit those economic goals of 2024. So that 5% or above 5% target might be something that they're still targeting at this hour. In terms of the market impact, there is some early disappointment, right? I think traders are getting a bit impatient that we're not getting anything new right now. You see that in the iron ore price, for example. We're actually seeing futures in Singapore in the red right now. And what we're seeing is a pairing of gains on the A-share market, Dave.
Yeah, there's slightly more details coming through. There'll be increasing income for low and mid-income groups. The how, though, is lacking. There'll be increasing subsidies for students. Still with us here on set, Helen Qiao and Eva Lee. Helen's with BofA. Eva, of course, is with UBS. Let's throw this forward. When do you think, Helen, the economy starts to respond, if any, to what we've heard collectively the last 3-4 weeks now?
Well, I think in terms of the announcement from the monetary and also financial perspective, that was made 2 weeks ago, and I think that we're probably going to start to see its impact slowly coming in as early as right now, because this is just a post-Golden Week and people are back, and the interest rate cuts, triple R cut with liquidity released into the system is already starting to kick in. However, would you necessarily be able to see it visibly, right, in the economy, in the data? I think that may take some time. My imagination would be that we have to wait until December to look at the October-November data to have a better sense of how strong the impetus is. Because at the moment, we're still looking backward, right? We are about to see the third quarter data and also the September data, which was at that time not exactly impacted by the adjusted policy measures. So that, I think, first of all, it's going to take a little bit of time. Secondly, it depends on how much more follow-ups we're going to see. And like what you and Yvonne just mentioned, it is not going to be just, a monetary type of easing measure by themselves. Better they could supplement it with some fiscal measures, and hopefully NDRC is saying something, that they are going to introduce as the completely new measures that we're not aware of, not just implementing the existing ones better. And so that we actually could have better hopes for going forward that this whole policy package is well planned and it will be implemented in steps so that we can see some sustainability of that. So if that's the case, then we can see probably better Q4 and especially better Q1 2025 as a result of policy easing. But at the moment, we don't have enough information yet.
Eva, if I have to wait till November, December for better data, I'm also getting to geopolitics. I'm getting to a U.S. election as well. How do I square those two things together?
Well, I think there's one more thing. It's we talk about the result season. I mean, the late October, early November, some of the internet companies is going to have their third quarter results. So after all these measures, what would they say about their 2025 earnings outlook? Fourth quarter is too early. I mean, it's just like economic data. Too early to see it like a major change. Obviously, in this week, we're still watching closely on the National Week holiday, how people, whether people will be more willing to spend on the discretionary side, housing market. I heard that in Tier 1 cities, some of the secondary market owners already withdrawn, their original plan to sell. Now they look back and say, maybe I can sell it at a higher price, so withdrawing. So, and looks like maybe housing sales, would it be better compared to pre-measures? Probably the case. So that are some of the anecdotal evidence that we are, monitor closely to understand, what are the impacts.
Right. Well, thank you so much for spending the time with us here. Helen Qiao, Chief Greater China Economist at BofA, and Eva Lee, of course, out of UBS Global Wealth Management. It's worth noting that we're starting to get some lines here coming through on fiscal, speeding up the issuance of local government bonds. They'll continue to issue and sell ultra-long Treasury bonds in 2025. And I think that underscores the point that we've heard from monetary officials. We've heard from the economic planner. We've yet to hear from the Ministry of Finance. They've yet to come out, and not to say that they will, but that's where we are as far as the sort of incremental steps towards boosting this economy is concerned. This is Bloomberg.
For the use of local government special purpose bonds and expand the area, intensity.
Welcome back. You're watching the China Show. A look at how these Chinese markets are faring here as we digest these lines from the NDRC briefing in Beijing. You're starting to hear a little bit more of maybe more guidance on what these spending plans are going to look like. So the latest is basically issuing 100 billion yuan worth of investment for next year early. They're going to ramp up local government's use of bond money on projects as well, and talking about issuing ultra-long sovereign bonds next year to support these projects. Let's hear a little bit more from the chairman.
Listen as much loans as they can. And we will incorporate a series of eligible major projects into the 14th five-year plan for energy intensity and encourage local governments in buying green electricity and green energy certificates to boost the consumption of renewable energy. Fourth, regarding the real estate sector, we will strictly control new increments, improve the existing stock, and boost the quality of commodity housing, and strengthen loans for whitelist programs, and make use of special purpose bonds to make good use of idle land, to revise the home buying restrictions, to unleash the essential needs and needs for better housing, to digest the unsold commodity housing, cut existing mortgage rates, etc. We will improve land, fiscal, tax, and financial policies and work faster to develop a new model of real estate development. Policies including existing mortgage rate cuts have been introduced, and some cities have lifted their home buying restrictions. Some have reduced the areas where the restrictions are practiced or relaxed the conditions for the restrictions, and other policies are being advanced as we speak. Fifth, regarding the capital market, relevant departments will take effective and comprehensive measures to bring medium and long-term funds to the market to address the bottlenecks so that money from social security, insurance can enter the market. We will support mergers and restructuring of listed companies and advance mutual fund reform and introduce new measures to protect the small and medium investors. Going forward, we will follow the situation closely, assess the effect of the policies, and make good preparations. This year and next year, we will strengthen the coherence of policies to support our economy in going up and the development momentum of our economic growth. Thank you. You mentioned boosting effective investment. What measures will be taken in this regard?
Thank you. I will ask Vice Chairman Liu Sushe to answer your question. Thank you for your question. This year, with a focus on key areas at key links and using government investment to galvanize all society investment, we have introduced a series of measures. And Mr. Chen has just shared with you a lot of measures, and allow me to add some information. On government investment, the nearly 6 trillion yuan of government investment has been allocated to specific projects, and we're accelerating work to deliver more physical gains. As mentioned, 700 billion yuan of investment within central budget has been allocated, and more than 85% of the projects under the local government special bond have started the construction. And we have begun construction of all projects under the 1 trillion yuan additional treasury bond. And we have issued more than 90% of the newly allocated special local government bond. Last year we had the ultra long-term special treasury bond, and now most of the projects have been under construction. We have attracted 441 projects that involve private.
Right. Again, a warm welcome to all our viewers. If you're just joining us right now, you're watching the China Show. We're taking you live, and we're live here out of Beijing, the live press briefing out of China's economic plan, laying out so far what mostly have been implemented and the details of implementing more fiscal push and further support to the economy on one hand. On the other hand, is you have markets that are, at least onshore, opened up 11%. We have, since that point in time, given up most of the gains. We're still up, though, 3.5% after being shut for about a week. In Hong Kong, the story is completely different, where we have been rallying for a week. And as things stand, the Hang Seng Tech Index you see on your screens is now on track for the worst day since the index inception back in 2015. We're nearing, if not already, about 10% losses, 10.7% losses now on the Hang Seng China Index. Is this simply repositioning, or, and this is speculation, are the markets somewhat disappointed in what they've heard so far here, given that, of course, markets have rallied 30 to 40% from the bottom over the course of just 3 or 4 weeks? Let's bring our guest out of Shanghai, Shenyi, CEO of Shanghai Shenyi Investment, a hedge fund manager based in Shanghai. He was also the founder of the Goldman Sachs ETF team in Europe, and of course a manager at Millennium Management. Shenyi, a pleasure to have you on the show. Thank you for joining us at such an opportune time with markets where you are reopening from the week-long break. I need to get straight to it. Is there a level you think of disappointment, question mark, with the way prices are trading at the moment, or how else should I be looking at the markets right now?
I would say it's not a disappointment. The market is in the waiting mode. Obviously, the market trade ahead of the financial numbers and the economic numbers. So people are waiting for a detailed figure. Is that going to be 1 trillion, 2 trillion, 3 trillion, or somebody said 10 trillion? If we have a 10 trillion, we're a huge rally. If it's 1 trillion, then we can call that a disappointment on the numbers.
Do you think we're actually going to get any sort of numbers today, Shenyi? It seems like no one there from the Ministry of Finance is there. And does it matter? How much does it matter to the market that we actually get an actual number of how big this fiscal push is going to be?
I'm just taking an educated guess. I would say we start with the central bank, and we follow with the financial regulation and the CSRC. Now the government are talking about implementation of all these measures. The number itself, my take, will be announced by the financial administration. So we'll see when the news conference will be launched, hopefully in next day or two. So we'll know the figure, and then the market probably come back into a rally mode.
Right. How would you trade this at the moment? And what investment advice would you give, whether that's for long-only investors, that's a separate advice, or to people, for example, in your hood of the market, which is quants, for example?
Okay. Our advice to our investors will be the asset allocation will be in the two parts. One, we call that a pretty low volatility absolute return strategy, and then we'll be focused on market neutral type. So right now it's a great opportunity because you have the index future trade at record basis and the volatility is sky high. So that'd be a great opportunity. You can use that for the replacement of these long bonds. And also the second one would say we need to take some probably more positive mode towards the equity market. Then in that sense, my suggestion to most investors is take the ETF or take index futures, because at this moment, we do not know which sector or which stock will be benefiting from the new policy or the new fiscal stimulus. So we'd like to take the direction right. We want long the index, long the whole China, then we'll figure out the details maybe in a week or two.
Can you tell us how things are doing in the quant world in terms of trading? We've heard that there's been some glitches. Those have been shorting these index futures, as part of these sort of market neutral strategies have been facing margin calls in the last few days ago. Shenyi, have you seen those sort of margin pressures easing now, or are we still dealing with some technical issues too?
There's two parts of it. I'd like to say, I would say quantitative trading, quantitative investment is the future of the investment. That's a trend. That's a definite. But the risk is about program trading, is about margin costs. And the stability of the financial system should not take the risk of these fat fingers or excessive margin risk. So at this moment, I think the regulation targeting the basically pre-trade risk on these program tradings, which is great. At this moment, we haven't seen anything really bad happen in the market, in such a volatile market with record trading volume. And the exchange has a little bit glitch last week. They did not expect the basically record number of orders on the opening. Now they adjust the order processing matching system on the open. They give an extra 5 minutes to match the orders before the opening to avoid the basically huge, I heard it was like in the number of 300 million orders in the same seconds. So in this moment, we say in both in Shanghai, in Shenzhen, in Beijing, all exchanges work perfectly, runs on time. Regarding the margin call, I would say most market neutral strategy, typically in China, they long stock and they short index futures as a hedge. In that sense, when the index future rallied up, then you need to give the cash to the future exchange. In China is the financial future exchanges. So that's the margin call come from. It's not about the over leveraged or excessive risk. It's just a regular, say, margin call. All they have to do is reduce some stock positions and move the cash to the exchange on the next day, which I don't think that's a big deal.
Okay, I want to get your sense of where, at least back to investor sentiment. We've seen a massive amount, to your point, right? Because we had a massive amount of turnover in the market going into the long holiday, we had those glitches, and some of our reporting going into the first day of trade today that, some of the brokers were called in early to make sure to stress test the system. Where do you think the flows are coming from is my question. In other words, the amount of money that's suddenly being deployed into this equity market, is that domestic cash sitting on the sidelines? Is that coming from somewhere else? What's the conversation among you and your peers right now?
I think at this moment, if you put the investment community into retails, fund institutions, and they're basically proprietary trading, I think proprietary trading are probably keep that position stable, maybe switching some of the stock rotations. From hedge funds, they're increasing their equity weight dramatically as fast as possible. And the retails are using up their cash in account at this moment. and they're opening new accounts the first time. They probably, as I heard, in the last 2 days, during the holiday, there's about 2 million to 3 million new equity accounts opened among all the equity brokerage, and probably another few million on the way. So investors are coming to the stock market, try to take a taste of the rally. And also existing accounts are seeing cash coming in from their banking accounts. So people are moving money from their probably current bank account into stock trading account to increase the possibility of adding to their equity positions. We see money coming from, I would say, all directions. Probably the whole week, this week, we'll see cash inflow in a big number.
Shen, you mentioned about right now it's hard to determine what sectors benefit from all the stimulus that we've heard so far. So focus on ETFs, as you mentioned. I mean, when can we start looking at individual pockets of this market, right? Because, you know, the guests that we talk to say you got to focus on consumption, non-bank financials. SOE trade is still very strong, even though it seems like a defensive play, but it's not. When do you start tilting towards more of those sort of trades?
This one will be my personal view. Probably does not represent other investors. I would see there's a huge focus on basically dividend stocks in the last year or two. The stocks are in the hands of insurance companies and some large financial institutions. Going to the end of third quarter, now it's the fourth quarter, going to the end of the year, they might want to lock in some of the gain they have, actually huge gains in these sectors. So there might be something coming in the selling coming, just lock in. They might reduce their positions in these stocks. You might see some selling in these dividend sectors. People are interested in right now the government talking about new technologies in EVs, in semiconductors. So people are showing confidence in these basically new industrial revolution type of stuff. So people are moving their money into particularly we call enterprise board. And there's a science enterprise board in Shanghai. You will see both, I would say, I'm still talking about index. These probably rally more than the traditional CSI 300 or Shanghai 50. In the sector-wise, actually, semiconductor lagged the entire market in the last few days. And the biotech is a lagger as well. Hopefully we'll see some rally in these sectors.
Shenyi, it was fantastic to have you on. Thank you so much for joining us this morning. Shenyi, their CEO of Shanghai Shenyi Investment. Coming up next, we'll be live in Taipei where the world's biggest iPhone assembler is set to unveil a new EV as it seeks to diversify its growth engines. Our very own Annabelle Jewelers is on the ground there from Hon Hai's Tech Day. All right, we're going to step away from these markets for just a second here and take you live from Taipei. Now you're seeing some pictures there from Hon Hai's Tech Day, with the highlight really being the launch of its new electric vehicle. Our tech reporter, Annabelle Jewelers, is there and joins us now. Belle, how are things going?
Well, it's a really big event here on the ground. We've already heard from Chairman Liu, for instance, talking about the company building the world's biggest supercomputer facility here in Taiwan. It's not just about AI servers. Of course, we know it's working very closely with NVIDIA, but it's also about these new business lines, and that includes smart manufacturing, smart cities, and also electric vehicles, as you say. You can see some of that lineup just behind me. We do actually understand from the company no big customer orders going in just yet, but I did speak with the man who's leading these efforts, Jun Seki. He's saying that perhaps there could be something toward the end of next year. I asked him if that order, will it come from the North American market?
North American market specific, but also Southeast Asians and Japan.
The North American market, a lot of that production could be done by your plant that's located in Ohio, in Lordstown there. That's a plant that is permitted to manufacture up to 350,000 vehicles per year.
Possibly, yeah.
Right now you've got tractors that are going through, but you're quite a long way from reaching that 350,000 production capacity. Do you see a time where you think the assembly lines could be working at 100%?
Of course.
What sort of time frame?
Let's say 5 years. 5 years is not long. We started the concept of EV like 2020s, now 2024. I think almost same range, we can make it full. But our policy is we want to be very close to our customers. And then we go like 150,000 for Ohio's, but we don't determine yet if we go next step in Ohio or any other place.
But you do expect by the end of 2030 then, by the end of this decade, to be manufacturing up to 350,000 vehicles in the US?
USA, yeah, or more.
There is a point at which it could make more sense for an OEM, a car manufacturer, to manufacture in-house by themselves. Mm-hmm. Some in the market would say that's around 50,000 units per year. Mm-hmm. How many customers do you need then to make that Ohio plant profitable?
It will be different depending on customers. And most of the customers start with very small volumes. But when we're looking at their volume requirement in 28, 29, very large. So with a timeline 29, 30 base, 300,000 vehicle is, let's say, minimum 3, a maximum 10.
So between 3 and 10 customers you would need for that to be...
3 and 10 vehicles.
3 and 10 vehicles?
Vehicles, yes.
How many customers then?
If customer has 5 is maybe enough.
But I guess it comes back to that same point around the cost analysis. How are you talking to legacy car makers about why it makes more sense for them, financially speaking, to outsource their production capacity to Hon Hai instead of doing it by themselves?
Yeah. We experienced exactly same through laptop. Like 20 years ago, one laptop was about $3,000, $4,000. At that time, most of laptop player built by themselves, and then laptop price coming down, and then some small player couldn't maintain manufacturing by themselves, and then at the same time, like EMS, electric manufacturing service players coming, and then it's shifted from OEM to outside service players. And then while laptop pricing is coming down, actually their profitability going up because we manage their manufacturing better than in-house. And then this is same for smartphones, game machines. Why not for vehicles?
Hon Hai is dreaming really big in this space, but of course that needs a big amount of effort, and we're going to speak with some of the partners it's working on with this in the process. Pininfarina, for instance, that's the vehicle designer behind some of these models behind us today. Italian company made famous for designing Ferrari, for instance. That CEO is joining us just ahead, and the big one as well, of course, Chemin Liu of Hon Hai, talking more about their ambitions around AI server racks in particular, and the build out with the likes of not only NVIDIA but also Amazon, Microsoft, Alphabet, lots of big partners in the mix as well.
Some good work there, Belle. Thank you so much. Great stuff. More to come, as Belle was pointing out there, out of Hon Hai Day. Our tech reporter, Annabelle Drew, is joining us out of Taiwan. Right, just a brief look and back to markets. Right now, the big story, this reopening that I guess to some extent has lost steam. We opened 11% up on the CSI 300. We've since sort of found a floor thereabouts at about 5% gains. Most stocks are still up, 250 stocks on the way up, massive volumes coming through. As you can see, declines in Hong Kong, although we also did start to come off lows as well in the session.
Yeah, same goes to the commodities, where you feel a little bit more of that disappointment, right? So iron ore in Singapore, for example, dollar futures are down some 1%, but you're still seeing some upside when it comes to steel, for example. But even crude, Brent markets, by the way, breaking below $80 right now as well. That's it for us here on the China Show.